Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video, it has been a little while, but I want to talk about this put option selling strategy that I really like. So without further ado, let's jump into this. And as always, I want to start out by talking about what I've been doing with my money. And so here's my positions right here. Currently, today is October the 12th, 2019. I own 400 shares of steel. I have two long call options, strike price $15, expires in 2021. And then I have two short calls. Those are covered calls that I sold, and I just sold those last Friday, and I took in $109 on those, so that's pretty cool. My dollar cost average on the 200 shares that I bought is at about $11.35. And so if steel trades above $11 between now and when they expire November the 15th, then I will make $109 minus the $35. So I'll make $85. Is that right? $85 profit on that. And that's pretty good for a $1,100 investment. It's very good. And then I have the same 6 put options. $10 strike price, expires in 2021, that I bought several months ago. Option caller strategy right there. Now, let me talk about this put option strategy here. And I started selling the open puts, and let me go to my transactions, and let me go back to last month because that's when I started doing it. Click the view here. And right here is when I first started doing it. All of this up here is me trading covered calls. But right here where you see the green numbers, that's where I started selling puts. And on the 24th, I sold 6 put options, expires October the 4th. That would have made them 2 weeks. And I took in 10 cents per contract. But I only got $48.44. And I paid... Ameritrade was charging $6.95 commissions per trade. Now all of the major brokers are charging free commissions, and that's a very good deal for guys like me that like to buy and sell options. And so I paid $11.45, $48.44, and down here you see removal of option due to expiration. I got the full $48.44. Didn't even buy them back, and that would have been on the 7th. That would have been last Monday. And so that was on the 24th. And then on the 3rd, I sold the open 6 more. And those are weeklies. And notice the commission is only $3.90. So there are 2 things I want to say about this put option selling strategy. And let's go to steel, and let's bring up the option chain here. Okay, so here's steel. And steel closed last Friday at $11.34. If you follow steel, then you know steel went up big Friday. It went up over 11%, which is crazy. Steel is a very volatile stock, which is both good and bad. It's good because you can make a lot of money. It's bad because you can get in over your head, and you might go too big, too strong, or make all sorts. It's easy to make mistakes on these volatile stocks. But anyways, steel closed at $11.34. Now, let's look at options 34 days out. Let's say you wanted to sell the open $11 put. That's out of the money. The bid is $77, the ask is $79, so $78. Now, look at this return. This is a month, okay? Look at this return. Let me go to the calculator here, and let's put in 78 divided by 1100. And you get a 0.07% return. And let's multiply that by 12 months. And we get 85% return annually. That's crazy. Okay, imagine making a 7% monthly return or whatever it was. Imagine making 85% return. And that's selling the open puts here. So let me go back to the option chain here. Okay, that's a month, right? And that's pretty darn good. So if you were to somehow able to replicate this, and the only way to replicate it is for steel to stay at its current level. So a month from now, it would have to still be at 1134 or pretty close to there. But it still goes up to 12 or 13. You're not going to be getting 70 whatever. You're going to be getting like this. You're going to be getting 42 or 43. That's one of the reasons why I say that selling covered calls and selling cash secure puts is not an income strategy, because of that reason. Okay, these numbers are always changing. Income doesn't change. It's like your job. You go to job, you work 40 hours a week, and you get the same paycheck no matter what, $15 an hour, whatever it is you make. But that's not how it works with covered calls and also cash secure puts, which I'm explaining right here. Okay. But if by some wacky freak of nature steel was to stay at this level for 12 months in a row, it is true, you would indeed make this 85% annual return, right? Wouldn't that be a wonderful world? Okay, now that's a month, but look at the 1 week, same strike price. Let's go to 6 days and let's look at $11. You get bid is 28 and the ask is 29. So let's just say you get the bid, $28, and that's in a week. Now let's go back to our calculator and let's look at the return on that. Okay, so we take $28 divided by 1100 and we get looks like a 2.5% return in a week. So let's times that by 52 times 52. Now, is that crazy or what? That's a 132% return on your money. That means you would double your money plus 32%. So the numbers speak for themselves. When you are selling the open weekly options, you're possibly going to make way more money than you could ever make selling monthly options. And even if we were to compare that to, let's say, 13 days, okay, $11 put in 13 days, you're getting, the bid is 40 cents, the ask is 41, so you get 40, right? But if you're making $28 a week, isn't that a lot better than making $40 every 2 weeks? So the greatest money that you can make is in selling the weekly. But the problem, and this is my second point, is the commissions. But now that problem has been solved because now commissions are free, right? Let's go back to my transactions. So I have sold to open, and let me go to September here, which is where I started selling to open these weekly puts, okay? So I sold these ones, and I paid, and those were expiring in 2 weeks, right? And I paid the $6.95 that Ameritrade was charging, and so I paid $11.45 for those. Okay, now this one here, those are weeklies, okay? I sold to open those on the 3rd, and those expired just last Friday, and I'm already getting a message down there, removal of the option due to expiration. So I guess you could say Ameritrade is pretty confident, I also am pretty confident that steel is not going to be opening below $9.50 a share come Monday morning. And so I'm going to get all of this. I've already got all of that because those expired back on the 7th. So I've made all that. And Friday I sold 2 covered calls to lock in profits. That's a different video. I don't want to mix up my videos here, but I do plan to do a video and go over the covered calls that I've been trading, because what's happened to me on the covered calls that I've been trading is very interesting and would be, I think, a very good learning example for anybody who wants to watch the video. But this is me explaining the put options. If you want to sell the open put options for profit, I think selling the open weeklies is wonderful. Now, look at the strike prices I've been selling. I've been selling $9.50. Okay, so steel has to go all the way below $9.50. Okay, now for this one, I got 8 cents. Okay, and that doesn't seem like a lot of money, right? But let's go to the calculator and let's see. Okay, so I sold 6 of them, right? So what I would do is I would take, actually let's take the exact number. Let's take the $43.99 and let's put that in the calculator. Okay, so 43.99, and actually I need to multiply 950 times 6. So let me do that first. 950 times, oops, little typo there. Okay, 950 times 6. Okay, so that's the money. That's the leverage that I'm dealing with. So I'm going to take that $43.99 and divide it by 5,700. So let's do that. 43.99 divided by 5,700 equals, so that's the money that I'm making in a week. So let's times that by 52 weeks. 52 weeks in a year. And I'm making a 40% return if I can somehow manage to replicate this. And again, it's hard to replicate this because right now, if I look at $9.50 puts, just for kicks, let's look it up. Let's see what those $9.50 puts were going for if I was to sell a week. Option chain, I have to go to out of the money here. $9.50, the bid is 5, the ask is 6. So let's say I only get 5 cents, okay? If I were to sell 6 of them, I'd get $30 minus the 70 cents, so that's $4.20. So I would get $25.80 for a week. So that's less than the $43.99. So I wouldn't be getting that. But let's just for interest, let's see what kind of return that is. 30 minus 25.80. So 25.8 divided by 5,700. That's only a 0.45% return in a week. Now let's times that by 52 weeks. That's still a 23% return, ladies and gentlemen. So I think I can rest my case. Selling the open weekly puts with this free commission is a pretty darn good deal. So if you're looking for a nice, safe trading strategy, I think this is a good one. Okay, if we go to the charts here, actually let me pull up the TradingView since that's the best website that I like the best. And let's look at the support and resistance. Let's look at the trends here for steel. So if you're looking for a nice, safe trading strategy, I think this is a good one. Okay, so let's go to a year. Let me get rid of all of that. Actually, let's look at 6 months. Okay, so actually, let me go back to a year. Okay, so in a year, the lowest it's been is $10. It's never been down to $9.50, which happens to be the strike price that I've been selling. Okay, so that's why I think this is a pretty good strategy. The only way you're going to lose money is if steel goes below $9.50 a share, right? Because when you're selling the open cash secure puts, if, let's say, you sell those $9.50 strike price puts, steel goes down to, let's say, $8.50. Well, you sold a put option to somebody else. Somebody else is going to say, okay, steel is down to $8.50. I'm going to sell you 100 shares of steel at $9.50, which happens to be the strike price of the put option that you sold me. So you have to buy 100 shares of steel at $9.50 a share, but steel is only worth $8.50 a share. So you're basically in the red $100 for every contract that you sell to open. That's the risk. So when you sell to open these puts, all you got to ask yourself is, what are the chances that steel is going to go below that number? And if it does, do you have a stop loss? So you must have a stop loss. You must have a line in the sand where you say, okay, if steel goes below whatever, $9.50, and my plan was I was planning to buy more put options. And I'll close the video on this little point. Steel just came out with the brand new puts. They now have 2022 puts. And so my plan is very simple. I'm going to keep on selling those puts, and if steel does drop below there, then my plan is to buy some $10 puts or some $8 puts. That way, if steel starts going below $9.50, I will tack on another, few puts. Maybe I'll get another 6 puts. And that's the reason why I like to keep cash. I don't like to put all my money into one option trading strategy. I like to have cash in the wings just in case I need to do something like that, because I don't like the idea of closing out and just completely junking a strategy that's been working for me. This strategy works, and it's been working for me, and it's making me money slowly but surely. You saw the numbers. The return on these, what I think, very safe option trading strategy, selling to open puts, is pretty darn good. 23% return is pretty good. That's what I say. And that's it for this video. If you have any questions whatsoever, feel free to ask. Thank you for watching. I will see you in the next video. Don't forget to give me a thumbs up. Have a great day. Ciao.